The Monetary Policy Committee began its bi-monthly meeting today to decide on the inflation rate. Economist at PwC Maura Feddersen joins us now for more. Now, consumers and those that are repaying their debts and repaying houses, you like to hear the word cut. Is that likely to happen this time around, given the inflation is within the target band?
There are a number of factors that the South African Reserve Bank will keep a close watch on. Firstly, it is really fantastic news that inflation has been on a downward trajectory for so long. In March, inflation was just 3.8%. This is a multi-year low, the lowest we've seen since 2011. So this is great news for consumers. It means that consumers' purchasing power is increasing. We can buy more goods with the money that we earn. And it also means, in real terms, we are making greater returns on our savings. And this is much needed. With the VAT increase that we saw, consumers' pockets are again under strain. So while this is great news, there is a snag. It seems like inflation may have approached a turning point, potentially in coming months, increasing again. And there are a number of drivers that could be fueling inflation.
But it's not only about those that are repaying loans, of course, and that prime lending rate of 10%, but some of them that are saving. I mean, 16% of South Africa's GDP is made up of savings. So what happens with South Africans that are saving? Is a cut a good thing, or is the current interest rate doing well for them?
A cut would be great for South Africans, also because we are very much a consumption-driven economy. So given that since the beginning of the year, consumer confidence has been picking up, we are potentially consuming more again. And this also explains why the South African Reserve Bank revised upward its expectations for growth in 2018 from 1.4% to 1.7%.
But now, when we look at the decision made last time, it was a split of 4-3. They started meeting today. Is there likely to be a split, given that, as you said, VAT could affect the inflation rate going forward?
There are a number of key risks to the inflation outlook. Perhaps the most important one is the rand exchange rate. Since about the middle of March, the rand has depreciated about 8% against the greenback. And given that there is a continued possibility of monetary policy tightening and faster than expected monetary policy tightening in developed markets, the rand may continue to trade weaker. And this has implications for imported inflation, because the goods and services that we purchase from abroad would become more expensive in rand terms. And one of those import goods is oil. And oil prices have also been increasing. It's
$80 a barrel today.
Absolutely, yeah. Breaking through a structural ceiling at the end of last week. And this feeds through to petrol prices. South Africans have already seen a number of petrol price hikes, and it is possible that petrol prices could increase to 15 Rand 46 by June. This feeds through to transport costs, of course, but also food price inflation. So the rand exchange rate, then your increases in tax and your increases in oil prices together mean that it is potentially not likely that the Reserve Bank will actually cut rates on Thursday.
Is it any significance then that they keep those rates unchanged? What does it mean if they're unchanged?
It means perhaps business as usual. It means that at least rates aren't increasing yet. In March, the Reserve Bank mentioned that according to their model, which is one of the tools that they use, it is possible that rates could increase by 25 basis points by the end of 2019. It also means that if the outlook for inflation actually were to improve noticeably, the Reserve Bank would be ready to cut rates.
All right, thank you very much. Hopefully we'll see an upward trajectory in the growth number as well. That was Economist at PwC Maura Feddersen for that economic wrap on the interest rate.